Welcome back to Trendlines Over Headlines, the show where we break down the markets with some of the best traders and analysts out there. My name's Patrick Dunuwila. I'm the editor of the Chart Report, and I'll be your host. We've got a great show for you today. Jay Kaeppel will be joining us to make sense of the markets. Jay is a senior research analyst at SentimenTrader. He's published 4 books on trading, and he's got more than 30 years of market experience under his belt. So I'm looking forward to picking his brain, but before we talk to Jay, it's Friday, the markets are closed, so let's take a quick look at how this week played out. Hey guys, thanks for watching. Just a quick reminder, be sure to click like and subscribe so we can continue bringing you awesome content. Thanks. All 4 major indices closed higher this week. The NASDAQ led, rising about 3.5% to a new 52-week high. The Dow lagged, but it still managed to close slightly higher. Taking a closer look at the S&P 500, it didn't quite clear that 4,200 level that everyone's watching, but it closed just 8 points shy of it. Resistance was really around 4180 and it closed at a 9-month high. So if this is a breakout, we need to see some upside follow through in the next week or two. And it's crucial to see former resistance start acting as support in the near term. If it fails to hold above that 4180 level, we could see a sharp move lower. So definitely watch out for that. But overall, some pretty constructive action at the index level this week. Taking a quick look at the sector performance, 7 of the 11 sectors closed higher. Tech led, gaining more than 4%. On the other hand, utilities lagged, dropping 4%. But as you can see, it was a pretty risk-on week in terms of sector performance. You had some of the more aggressive sectors like tech, communications, and discretionary all leading, while some of the more defensive sectors like utilities, real estate, and staples all lagged. Anyway, that's enough from me. Let's talk to Jay. All right, Jay, welcome to the show and thanks for coming on.
Thank you for having me on. Great to be here.
Yeah, I'm a huge fan of your work and the way you look at markets and of course the work that all of you guys do over at SentimenTrader. But we got a lot to cover, so let's dive right into the markets, shall we?
Okay.
So if we start off with the S&P 500, everybody's watching the same level, right? 4,200. You hear it all the time. And we came awfully close today. Of course, we're recording this on Thursday, as always. We came awfully close. We were just checking before we recorded this, and it closed at like 41.98, right? Just a couple points short of 4,200. But we did get a nice, I think it was a 9-month high. So we did clear some resistance today, but what do you think of price action recently? Do you think we'll finally extend above 4,200?
Well, truth be told, I'm very bad at predictions. So whatever I predict will probably be exactly wrong. But the bottom line is everything that I look at the moment, it's net bullish. Not 100% bullish by any means. A lot of the big picture items like valuation, inflation, even the economy are still big question marks. But in the middle of last year, we started seeing bullish signals from a lot of sentiment, a lot of oversold breadth. And then in the last few months, that's turned into bullish breadth. And now the market is bumping its head. And it's very important that it breaks through soon because as we recently saw in gold, if something market bumps its head a few times and does not get through, it has a tendency to break back down. But given the overall state of affairs with what I look at being bullish, I'm still positioned for it to break through.
Yeah, and I know you're a seasonality junkie like me, and I won't ask you about sell in May and go away. I think that topic's been beaten to death. But I'm wondering, are you watching anything from a seasonality or cycles perspective here?
Well, one of the things that's been really great for me this year, if you can actually go to the next slide. So this is an equity curve of the growth of a dollar if you were invested in the NASDAQ 100 index only during the first 7 months of every pre-election year. And as far as I'm concerned, it's tough to find a better looking equity curve than that. So at the start of the year, I wrote about this and I said, don't be surprised if the NASDAQ rallies. And as I mentioned before, I'm not very good at predictions, but I'm pretty good at looking at a chart like this and saying, this looks like a pretty good thing to keep an eye on and maybe get into. So this has paid off very nicely. If you look at the far right-hand side, that's the equity curve. That's the growth for the NASDAQ 100 so far this year. It's over 20%. By far the leader. So been pretty fortunate there. And we still have a little bit left to go. It's only the middle of May, and this technically runs through the end of July. So it's one more thing that I'm looking at saying, hopefully we'll continue to get more follow through.
Yeah, I think that's interesting. As I mentioned, sell in May, go away, gets all the attention, but I think it's important to keep some of those bigger picture cycles like the presidential cycle in mind. I mean,
right.
Heading into this year, there were a few technicians, obviously you too, noting that the pre-election years tend to be the best year of the 4-year presidential cycle. Isn't that right?
Right. Oh, absolutely. Absolutely.
And on top of that, the midterm year, last year was the worst. So we're kind of seeing those cycles play out, right?
Right. Sometimes, seasonality, to me, it's just one more tool that tells me where to look. In other words, it's not a magic trick. It's not secret sauce. It's just these things tend to play out sometimes. And when they do, basically, like I said, it tells you where to look for opportunities. And then if the seasonal trend says to be bullish and that particular market or stock or index, whatever it is, actually starts acting bullish during that time, that's the clue to get in and, possibly be aggressive. So,
yeah.
Actually, if we can back up one step.
Sure.
To the previous chart. So, I showed here the line in the sand, as everybody knows, for the S&P is 4,200. The NASDAQ has its own that I'm marking at about 13,750. And it's not quite there yet. So I'm kind of keeping an eye on that one. Hopefully it'll get through. The other thing that's really important, the bottom one here is the NASDAQ, and it's highlighting the new highs and new lows. And interestingly, I'm not exactly sure what to make of it. Despite the huge advance that we've had in the NASDAQ this year, still more stocks are making new lows than are making new highs on the overall NASDAQ composite. And that's a little bit worrisome. At this point, I'm willing to just go with the trend, but at some point, these numbers need to flip positive to show that it's really a bull market.
Yeah, I can't remember the last time I've seen so much concern over market breadth here. Yeah. And I get it. I really do. But what do you think of all the narrow leadership going on right now? Do you think those fears are kind of overblown, or is it a valid concern?
It's a valid concern. And I think that's why people are watching these. That's why the market's having so much trouble breaking through, because it's just there's not enough stocks providing the oomph, if you will, to get it through. But these things tend to build on themselves. All it really takes is a breakout and of a few days, and all of a sudden a lot of people will come piling back in. I think there's a lot of cash on the sidelines, a lot of doubt and fear, but as you know, nothing makes people more bullish than the market going up.
That's correct. Do you think there is a scenario where we could see, some of the heavyweights like an Apple or Microsoft? Do you think there's a scenario where we could see them correct a little bit without the whole broader market falling apart? Maybe some of the other components step up and start participating where they haven't been?
I'm not really good at predicting those kinds of things. I think those leadership stocks need to continue to lead because they're such a big part of these indexes. So, if people see, like I said, if people see these indexes breaking out, they'll climb on board. And if the big stocks start to tank, that's not going to happen.
Well, I know you guys obviously do a lot of work on sentiment over at SentimentTrader. So I got to ask you what your read is on the crowd here. You put out an article earlier this week talking about this large net short position among small speculators on some of the indexes. Now, you weren't just looking at normal CFTC data here. You looked like it was something a little more proprietary than that. Do you mind telling us a little bit about the inputs to this chart here, this indicator, without giving away too much of the secret sauce?
Well, it's mostly just public data that we put together. And basically, you know, what this really is showing us is stock index traders who trade in small lot sizes tend to be less sophisticated than professional, quote unquote, investors. And all that really means is they tend to be more susceptible to the emotions of fear and greed. And so the bottom line is they tend to be wrong when they act in a big way, whether bullish or bearish. So this chart that you have on the screen, the top line is the S&P 500 index, and the green line is the 50-week moving average of the position size, the net position size for small speculators in stock indexes. And the red dots are what I call when they are bearish, or at least they're not bullish. And so when the people who are typically wrong are not bullish or they're bearish, that tends to be good for the stock market. And if you look at the red dots in that top line, the S&P 500, you can see stock market tends to do very well when these people are on the short side of the market. And then the table at the bottom kind of sums it up. You know, the average 1-year return for the S&P is about a little under 17%, with a 90% win rate when they're betting against the market. And the reason I wrote about it now is you can see at the far right-hand side, in the history of this particular database, they've never been more bearish. So to put it a different way, if the market were to crash tomorrow, essentially the worst traders in the world would make a killing. So the rhetorical question is, how likely is that to happen? Anything's possible, but given the history, this seems like a pretty bullish piece of data to me.
Yeah, I mean, that indicator there has really just fallen off a cliff, you know, indicating a huge net short position. Now, you did mention in the article that there was something, some new product that came to market that might have been causing that massive drop. What was that?
Well, so part of it is in the last report, they added the mini contracts, which they have not done before. Okay. Now, I think that's going to make it a better indicator, because the mini contracts are where the small traders really tend to migrate, who were not even recorded before. Also, while it did make a difference on a 1-week basis, this green line that you see in the middle here, that's a 50-week moving average. So it's not due just to 1 week of aberrant data. They've been reading the news about inflation and the economy and the debt crisis and et cetera, et cetera, et cetera, and they are positioning for a bearish move.
Yeah, it's pretty clear as daylight.
That might be good news for the rest of us, but I don't know. We'll have to wait and see.
And I think that's, I'm glad you reiterated that point, that it's a 50-week moving average, you know, so that takes a while to turn. And when it gets to extremes, that's a pretty big extreme, right?
Yes, it is.
So I want to shift away from the broader market a little bit and look at some specific areas within it. And I think an interesting relationship going on right now that's kind of a microcosm for what's going on more broadly this year is this ratio chart you shared here of technology versus the energy sector, right?
Right.
And that relationship's just kind of a mirror image of what we saw last year. You know, energy was pretty much the only sector that worked. It had a great year, while technology had a horrible year, probably the worst year in maybe a decade for technology. And then that relationship's just kind of reversed, right? Energy is the worst performing sector this year. Tech is doing great. So what do you think of this ratio here, of this pair? And what does it say about the broader market? Or what could it say?
Sure. Well, the reason I actually pointed this chart out is this shows the performance of tech relative to the performance of energy with a 24-month exponential moving average. And I did a test back to the 1920s. And what I found is when tech is outperforming energy on this basis, the S&P has gained roughly about 13% per year. And when it's the other way around, when energy is leading technology, the S&P gains only about 3% a year. So it's bullish for the overall market when this is rising. And it certainly was the case during the period that you see here. I mean, from 18 into, the early 2021, tech was by far the best performer. And then when energy took over, the stock market tanked for a variety of reasons, mostly inflation. But the other thing that's important to note is, as you mentioned, on the far right-hand side, it's trying to turn back up. And in fact, it has turned back up and is trending higher. So the question is, will it follow through? And as I said before, I can't predict things too well, but I'm keeping a close eye on this because, like I said, if this does follow through, that should bode well for the overall market.
Yeah, I would have never thought to look at that relationship between tech and energy and its implications on the broader market, but it makes sense, right? I mean, technology represents about a quarter of the S&P 500, whereas energy is tiny. I mean, that's, I think, probably under 5%. I know it changed from last year. It used to be like 2.5%. Right. But it definitely grew a little last year. But that would make sense, right? Seeing the biggest sector outperforming, the entire index would probably do well, right?
I actually look at it just a little bit differently because that percentage of the overall market, that changes over time. In the 80s, energy was a huge part of the overall market. So I think it's more a case of when technology is leading, it's a sign of good times. General euphoria, things are good. And when that drudgery of energy takes over as the leader, it's typically more of a grinding affair in terms of the overall economy and the market. So I think it's almost as much of a sentiment indicator as it is anything else.
Yeah, I like that point. That makes sense. Kind of a risk on, risk off kind of gauge, rather than being a function of the weightings of the indices. That's a good point.
I think so.
Well, so, kind of goes along with energy here, but commodities have been awfully weak this year. And of course, they had a great first half of the year last year. They kind of stalled after the summer last year and have been stalling ever since. But, here we have DBC flirting with new 52-week lows. And it's not just, DBC is a lot of crude oil in there, but DBA here, it's kind of failing to hold above the September highs there. So also looking kind of rocky. And I'm wondering, I know you look at commodities pretty closely. Do you have any thoughts on how the rest of this year might play out? I know you don't want to make too many predictions, but what do you think of this price action?
Well, I have a lot of thoughts. So as far as the chart you're looking at, DBA, wheat is entering a very weak seasonal period right now. Corn and soybeans are typically very weak in July and August. So I'd be very hesitant to be long DBA right now. Commodities are best followed on a trend following basis because when they go, they really go. And they make huge swings. So right now, I'm not really in any commodity positions on the long side.
Yeah, I mean, to that point, they've been kind of trendless for almost a year now, right?
Right. But there's a few things that I do follow. And again, it doesn't go under the category of predictions. It's more just kind of keeping an open eye, an open mind to what may be coming and being ready to go when the time comes. So I don't have the chart, but I can describe it to you. If you saw a chart of let's say the Bloomberg Commodity Index divided by the S&P, and let's say you went back 50 years, just picture a giant roller coaster with
So a
big
long-term
peaks.
chart of the relative performance of commodities?
Yes.
Okay.
Commodities versus stocks. And what you see are huge runs where commodities vastly outperform stocks, and then huge drops where it's just the other way around. And right now, if you looked at that chart, you would practically have to go underground to see how low it is. In other words, in the last 20 years or more, commodities have so vastly underperformed stocks that they're essentially, you could argue, they're almost giving them away.
Yeah.
And that will not last forever. And that's one of the important things that I always try to keep in mind when I'm looking at the news and it's saying this over and over and over again, something is happening. Things change, and no market, no index, no stock ever has a permanent advantage over anything else. So it's, yin follows yang, and the day will come when commodities will vastly outperform stocks. And I think that may be closer than most people think. I think if, we saw the big spike in inflation last year, and now it's come down quite a bit. Very often, historically, typically like in the 40s and again in the 70s, there was two runs in inflation. So if we get inflation that turns back up, then I think we're going to see commodities make a huge move. And there was another chart that I added.
Right here?
That's the one. Okay. So here's a kind of a crazy study I did. This is the Bloomberg Commodity Index. There's a 30-year cycle. Okay. 15 years are bullish and 15 years are, I'm going to call them blah. Not necessarily bearish, but they're blah. So these are the bullish cycles. So this goes back to 1933. So at the far left, if you invested $1 in the Bloomberg Commodity Index, from 1933 to 1948, the first 15 years, you had a very big move. Then you see flat for 15 years. That's when, being out of commodities. And then you pick up again 30 years after the first date in 1963, and you see another huge move in commodities. And then you fast forward again to 1993 to 2008. That's when gold made its big move in the early years of 2000, 2010, another big move. And the average of these three periods, a 15-year gain of about 300%. Okay.
Wow. And what was the signal here? What kind of quantified a bull run in commodities?
A date.
Oh,
a date
okay.
that's 30 years apart.
Oh, I see. I understand.
Okay. So started June 30th, 1933. And so like I said, the average gain for the commodity index during these 15-year periods was 300%. And the average gain for the other years that we don't see here was about 20%. And in fact, since 2008, the gain has only been about 2% for commodities. The good news is June 30th of 2023 is technically the next date in this pattern.
Wow.
Okay, so then the new quote unquote bullish 30-year period, well, it's 15, the first 15 years out of a 30-year period is beginning in a month and a half from now. Now, does that mean that everybody should load up on commodities? I know I haven't done it yet, and I don't know if I will or not, but I do know that when June 30th rolls around, I'll be keeping a close eye on commodity prices and commodity indexes and looking for an opportunity there. And the good news, especially right now, as opposed to in the past, the only way you could trade this was either via the futures market or in the cash market, which a lot of people are not, probably should not do. They're not prepared to do. Nowadays, you can trade a lot of commodities, including baskets of commodities, with ETFs and ETNs. So there's a lot of opportunities there. That DBC is one of those. In other words, if things started picking up after June 30th, you could buy DBC and have exposure to the commodity market, just like you would have exposure to shares of stock. So, that's the kind of crazy thing that I look at, to just kind of keep an open mind as to what may be coming next. But again, without making any predictions, I can't say I'm not going to pound the table and say the next 15 years are going to be super bullish for commodities. I'm just going to say they could be, and I'll be ready if they are.
I like that. So that's fascinating. Every 30 years, you see this cycle kind of play out. Like you tend to get a bull run in commodities. Am I understanding that correctly?
Mm-hmm.
Wow, that is pretty fascinating.
Yeah.
Now, one bright spot within commodities has been gold, of course, in recent months. We're all looking at the same chart, all looking at the same levels. Is it going to break those 2020 highs? So far, it's getting rejected, right? Which, as a sentiment guy, I think you'd agree, when everybody's waiting for the breakout, you're probably not going to get it, right? Or you're probably going to at least see some frustration. Yeah. They're going to make you work for it when that many people are watching the same thing.
I hate it when they do that, but they usually do.
Gods. Yeah. So what do you think? I do think from a sentiment point of view, I think it's an interesting one because, like I said, we're all watching the same one, but it doesn't seem like anyone's positioned for a bull run in gold. So what do you think as far as a sentiment perspective on gold?
Well, actually, the sentiment indicator that we follow for gold is smack dab in the middle. It's not saying anything.
Great.
It ranges from 0 to 100, and it's at about 52. So there's really no conclusions to be drawn from that. I did write a piece last week on the 11th of May and basically pointed out that the chart that you're looking at, this is about 3 years since it first bumped its head. And as I mentioned earlier, when markets try a few times to get through and they can't, they tend to pull back. And I pointed that out. And I also mentioned that there's a short-term bearish seasonal trend in play right now in gold that lasts through about the end of June. So I don't have a position in gold right now. I do know that Tom McClellan of the McClellan Oscillator has a cycle in gold. It's a 4-year cycle. And I know that according as I follow it, from the end of June this year through the end of February next year, 2024, is a quote unquote bullish period for that pattern. So again, that doesn't guarantee anything, but for me, I'm sort of biding my time. I'm not in gold, but as I mentioned, at the end of June, I'll certainly be taking a close look, and also keeping an eye on the inflation number if that begins to pick up, because people fall in love with the narrative. To kind of sidetrack for one moment, last year when inflation spiked, the stock market especially hates uncertainty, and few things create more uncertainty than spiking inflation. So everybody got scared, and we had a bear market. And then, of course, it started to come back down, and now people are getting used to every month it's a lower number. So if that does turn around and tick back higher, that's going to throw everything for a loop. And one last side note, as long as I brought the stock market back into the discussion, another study that I did looked at the 12-month change in the consumer price index going back about 100 years, a little over 100 years. And when that 12-month change is between plus 4% and minus 3%, that is essentially what I call moderate inflation, and the market loves moderate inflation. When it gets outside of that range, in other words, above 4% is too much inflation, below -3% is too much deflation.
Okay.
Over the last 100 years, during those periods, the Dow Jones Industrial Average has lost over 60% of its value.
Wow.
So the big hit that it took last year was not a surprise when I looked at inflation numbers, because the market tends to struggle in the face of rising inflation.
And where's that number at now?
4.9.
Okay, so it's above the range still.
It's above the range. So that particular indicator is still rated as unfavorable as I follow it.
Interesting. Yeah. And like you said, if that starts picking back up again, that could be a tailwind for gold, right?
Right. Yes, because people are now assuming the mindset that inflation, okay, the spike is over, it's heading back down. Let's see how low it goes, and I'm all for that. But we'll see what the market decides.
All right. Well, Jay, we got to wrap it up now. But
Sure.
Thank you again for coming on and sharing your thoughts. And we'd love to have you back sometime.
Sounds great. Thank you very much for having me on.
Oh, of course. Have a great weekend.
You too. Thanks.
Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Thanks.